this panel is defining the landscape of, how we can engineer yield access to bring institutional credit and real-world assets on chain. So we'll just start maybe briefly with introductions of yourselves, and then we'll get into some questions.
So my name is Julien. I'm the founder and CEO of Stake Capital. Stake Capital is a family office, and we been in the space for quite some time. We invest. We also build projects. We also have a significant amount of voting power and tokens in the space. I was also the first one to join and help on Curve Finance. That's it.
My name is Dinkelmeyer. I'm the founder and CEO of Midas, an asset tokenization business. We're tokenizing yield instruments together with Fasanara, MEV, Edge, and other investment funds. Prior to tokenizing asset managers, I've worked in asset management myself. I spent my career at Goldman Sachs and Capital Group.
Yeah, hi, Martin Quensel, co-founder of Centrifuge. So been in the space of RWA tokenization for quite a while and come more from the fintech corner. So what I did before was basically kind of a Web2 version of private credit, and started then with Centrifuge with the Web3 version and went through all the ups and downs, and Seb, you're being part of it.
Yes, so I was part of the success and failure of Martin, but co-founder of Steakhouse. And we are the largest creator on Morpho, a lending protocol. And we are also helped to launch Grove, which is a $1 billion sub-DAO of Sky.
From now on, there's only successes. So David Vatchev, head of tokenization at Fasanara Capital. So Fasanara is an asset manager focused on real-world assets and private credit. But what also makes us unique is we have a digital asset arm. So since 2018, we have been in that space as well with a market-neutral crypto hedge fund. So we really combine real-world asset yield with the liquidity and composability that's needed in DeFi.
Okay, since we have a lot of OGs of real-world assets, I think it's really interesting to hear what sort of specific pain points have you guys seen and experienced, and what sort of pain points do you see going forward?
So in the past and in the current, lawyers, we all love them, but they are not really on-chain compliant, and they always want us to be off-chain compliant. So it's actually quite complicated. All the legal aspects, especially, let's say you are a decentralized protocol, you want to invest in real stuff. You cannot come, oh, I have this DAO on a forum. That will not work. Then you need to spend a few $100,000 to get lawyers and to create a Cayman SPV and all that Cayman Foundation. That will take you 6 months, and then you can do stuff. But then you will still spend quite a lot on lawyers. So going forward, my view, and very interesting to hear what other people are saying, is liquidity. Getting access to those to the real-world assets, that's quite challenging. Having a price on chain, especially for those that are a bit more illiquid. We need secondary market. Primary market are fine, but we need secondary market on chain.
Yeah, I can copy that. I think we'll turn it around. So liquidity and structures to provide liquidity when you need it, I think is kind of now about to start, and it was really missing in the past. And I think the second point is really also something where we had built real asset structures in the past, where you basically, or it's still mainly the case, where we built blockchain structures on top of traditional finance structures. And of course, that is not more efficient and cheaper. It's actually the opposite. You create something on top, which is already, coming with some cost level, and you make it most likely even more complex and more costly. And I see already that is also about to change. So maybe we are learning more here in the panel.
Yeah, I would just echo all of that, but the way we look at it is it's really fragmentation. So siloed systems, as I said, interaction of TradFi legal versus DeFi. As I said, liquidity. Again, you have to operate and navigate different layer ones, let alone different networks within that, different token standards, and a very different user experience. So that's probably been by far the biggest challenge.
Well, I think it's a good recap from the. I think those challenges are now starting to be more and more easy to navigate through because of all the big names that we have heard recently making acquisition, M&A, or IPOs, or like Stripe, Revolut, as I mentioned before in the opening ceremony. So now the point, even so, regulatory wise, lawyers and etc. Were tough before. Now it's very strange because they're all asking how they can actually join. So there's a big shift. Still not easy to have the bridge between TradFi and DeFi, but it's becoming way more interesting, I would say, for players that are actually starting to be have significant amount of involvement in DeFi and TradFi. It's a big window opportunity. Yeah.
Dennis, anything to add?
Relaying on the comments, I think liquidity is a very, very important challenge to solve. However, it is actually important to remember that liquidity off-chain tends to be far deeper than the entire ecosystems we have on-chain. So this is a complexity we still need to challenge. I think overall the utility of blockchains and on-chain finance needs to improve much further in order to get a real product market fit for access on-chain.
You're just going to migrate to a chain like Solana, where now they're made protocol level changes, catering to institutions. Thoughts on this?
I can add to the point of latency. I think that's definitely a very, very important consideration. The one paradox we're facing here is that multiple computers will always have lower latency than one single computer. And when we compete on latency, for instance, the deepest asset pools we have today, not RWAs, but traditional asset pairs on DEXs or Curve, you actually still have price discovery happening on centralized exchanges because the latency is lower. It's very hard to compete against one computer when you verify with multiple computers. So that's sort of one of these mild paradoxes you face here. But the benefit of tokenization of any assets on chain is actually to transact on chain, and you have self-custody. So you send a token, then you receive the token, and you have no middleman in between. So that's a really important proposition, and allows other use cases than just the medium of exchange. And for that, for sure, latency is a very, very important consideration, and Solana will do very well, as other ecosystems will do very well too.
Yeah, I think latency is a good narrative in order to keep the VC and the chain and the market cap pretty high. But in terms of use cases, can be very different. I mean, in Web 2 or Web 1, even, have you ever heard a project saying, oh, I don't know my game, I cannot run on the Google Cloud because it's not fast enough? I mean, and Google Cloud or Amazon, they go by 100 or 1000x faster than whatever chain will be able to do. So the point here is, like, for most use cases, you don't really need to have fast transactions or settlement. In terms of real-world asset, if you ask someone, do you prefer having super fast chain, or do you prefer tapping into $2 billion US liquidity depth? I mean, they would choose liquidity, right? And the liquidity doesn't actually come because the chain is super fast. It comes because you have all the different components that you can plug and play: bridges, Oracle, regulatory certainty, all the different aspects. So.
Yeah, and if we even take a step back further to that, the very question from an institution standpoint, if anyone here in this room is sending an email from their Gmail account to an Outlook, they never really need to ask a question or think about the latency or the performance. It's obviously just already set. Whereas here, the fact that we have to keep continuing these conversations and analyzing different layer ones and plus and minuses just shows you how far we still have to go, and where this liquidity mismatch you were saying still needs to be resolved. So really, we need to sort of get over this and find a way that all layer ones can interoperate, and we can try and take what's the best of TradFi, but especially the liquidity that Dennis brought up. That's the key missing component.
Yeah, I was at the Goldman Sachs Digital Asset Conference 2 days ago. I mean, everyone was speaking about tokenizing on Ethereum. I never heard about Solana there. I mean, not anything else, to be honest. They just moved from Bitcoin to Ethereum. So it's not going to go faster than that. And just on the speed, I mean, there was a research paper saying there was a 7,000 real-world asset transaction over the last year. I mean, that makes one every hour. So we don't need to be super fast. Currently, the meaningful real-world operation transactions per day are exactly 0. Meaningful meaning not a niche product, 0. So we could even do it on Bitcoin, it would be completely fine.
Yeah, maybe I can just add that I believe we are not there yet, where we need that latency Solana is providing for real assets. At least, like what you mentioned about crypto assets and calling them traditional assets out of the bubble. I loved it. Anyway, I think it's when you build deeper liquidity structures and actually finally at the end need something like high frequency trading and kind of products you see in TradFi where I think you need really the speed of execution and milliseconds count. Sooner or later it will happen, but I'm not sure if we are there yet. If it comes to real-world assets.
I just want to make sure like the audience understand this is real-world asset, not like for other use cases like gaming or whatever, where you need like fast transaction, low cost, and etc. So the point of being a real-world asset, not necessarily having the need of low latency, it's something that is really important.
Speaking of, I guess, the chains that are being considered, at a certain point, you have a lot of liquidity fragmentation going on. How do you think the interoperability will look like going forward as, say, L2s develop? Maybe Solana and Drift and, Apollo get going somewhere. But what's your take on that?
Yeah, there are two sides of the coin. One, if you are a real-world asset issuer, it should not be too difficult to integrate more chain. You are just burning on one and minting on the other. It's centralized, so you just burn the token, you mint it on the other one. You have some KYC issues, maybe you have some cryptography risk, but nothing is impossible to manage. Now the other side of the coin is, why would you do this? And what are the implications? It's easy to add 10 chains. But if you just provide the support of minting on one chain and moving from one chain to another, what did you achieve? Because if there is no liquidity on each chain, and Sylvain Prigent from SG Forge was discussing this morning, they have a stablecoin they want to issue on many chains, but every time they need to seed the protocols, make sure there is liquidity, bootstrap, give rewards for people to use it. So it's just fragmentation of the workforce or the rewards or the liquidity they can provide, which makes it super expensive. I think it's better to win somewhere where there is actually users. So Ethereum is still the biggest chain by TVL or TVS. Any metrics, I think, are on those. So yeah, you really need to be where your clients are, not where the narrative is.
Yeah, I fully echo that. And this is just the point that even if there's 10 chains, 100 chains, or 2, as an institution, it means we have to have a strategy, a thesis around interoperability. That just brings an extra layer of complexity that our ultimate end investors don't really care about. We really need to, just to Sebastian's point, we need to think about where are the assets, where are the developers, where's the activity, where's the demand, and create use cases that meet that and be able to join those dots. But when we have to spend extra layers of complexity, it just adds more fragmentation. And most importantly, for end users, it brings more cost into the system, which doesn't help anyone.
Well, fragmentation is really good for us, for example, like people looking at arbitrage opportunities. But yeah, for people that are issuing new stablecoin or those type of products, it's extremely difficult. And the reason it's because it's extremely difficult that the market will tend to just one of a few different networks. Because, and we've seen it, if you've been in the space for quite some time, remember all those different chains, they either died or moved to an L2 in order to survive. So through the umbrella of Ethereum or other big chain, now if you look at the space, there's only like maybe top 5 blockchain. The other ones are either their own or an L2 of Ethereum. And this is what happens in a jungle, right? The strongest only survive. And depending on your skills, then you have different type of market shares. And here is exactly what we're saying. Like from the panel this morning from Société Générale, he was saying that for them, even if they have the capital, the resources, and the energy, it's extremely difficult to tap into multiple different markets. They need to talk to market makers, they need to talk to listing, they need to talk to liquidity providers and decentralized exchange, lending market. And because it's extremely difficult, then the market was shifting towards multiple strong chains with different use cases. One will be more specialized in a world asset, one will be more specialized in gaming, maybe Solana, fast iteration, low cost. But then you need the solidity, the strength of a big one that can guarantee you that the settlement is happening in the right way. Because if you transfer billions of US dollars, then you don't want to lose them, right?
We heard from previous panels about the various risks of bringing real-world assets on chain. I'm curious to see what your thoughts are. If you have a tokenized real-world asset, would you allow it to be deployed to a vault for rehypothecation? And if so, would that only be with professional managers, or would you just let it go free and let people reloop, as degens do?
Strong yes.
On all of the above?
On all of the above, yes.
But how do you manage that risk? Do you manage that risk yourself, or who bears the brunt of that?
My answer to this, I think tokenization in its own right is fairly useless if you don't have use cases. It's very important to remember that. I can invest in a BlackRock money market fund without a token involved. Possibly is that I have lower fees actually because transaction costs and otherwise. Tokenization is only really useful if you have composable use cases. So we need to have a base where we actually need to do and build real-world use cases that actually create real utility and real value. So in regards to tokenization, trading may not be the best one because you're pointing out regulatory risk. Trading actually in liquidity involves significant regulatory risks, specifically on multilateral exchanges. The trading and liquidity of assets is challenging, not just because of the latency of a decentralized network and computer, but also because of a regulatory sense. That's very hard. Now, repo transactions are fairly widely done in traditional finance. That on a risk profile, it really depends on a subjective interpretation, who exactly performs what activity. That's a very different thing. But I think we've seen examples where this works extremely well. Just because something is a real-world asset is actually a compliant security, it doesn't make it better or worse than other token crypto assets that may claim they are digital assets, but actually are RWAs. But to give an example, and we're very proud to announce this. So this is a world first. So I'll use this opportunity to use this. Alpha, so you're sharing the alpha. This is a world first. We're very proud of this. It's been 3 months of work going into this. So together with the team at Fasanara, we have developed a tokenized private credit fund that is a permissionless token and transferable token on the secondary market. Not OTC transactions, but we don't want to go into this detail. And we've partnered very closely with the team at Steakhouse Financials, and they've accepted us as collateral in the vault. They effectively provided liquidity to a market on Morpho. And together with Julien at Steakhouse, we've seeded this, we've brought it live to the market, and as of right now, this is the largest real-world asset tokenized credit fund in these rehypothecation transactions. We've actually just done the press release 15 minutes ago, so this is really a world first.
Yeah. So how much leverage do you guys have? How many times do you reloop?
This question is actually a question to the vault curators, which is probably best addressed.
So I think I checked. I mean, obviously it's super early. It will not be for everyone either. So it's MF1, which is a tokenized product. And I will let you explain a bit more if needed. But based on the F1, which is from Fasanara, so it's I will let you explain as well. But it's we call it private credit in crypto. It's not private credit only, but let's say private credit product with a 3 months. If you want to redeem, it's 3 months, and you can loop it on Morpho. You can use it as collateral on Morpho and have leverage up to 85% LTV. So let's call it 5 times leverage. So obviously, if you do this without thinking, you are in need for a disaster, because if you borrow at higher rates than what you are getting on the product, you will blow up quite fast and you will lose a lot of money. So that's why it took 3 months to make it in a safe way, and there was a lot of hurdles to accomplish. Now, to the original question, I mean, real-world assets are only as risky as they are actually. I know for crypto, I remember in 2020, there was a big war in MakerDAO. Oh, we want to accept USDC as collateral. And half of MakerDAO was saying, no, USDC, that's completely insane. It's super risky, it's centralized. Now, who here thinks that USDC is risky those days? I mean, if you are doing anything with stablecoins, most likely you are actually using USDC or USDT or others. USDT is maybe a bit more risky, but it doesn't matter. It's still now acceptable. Then there was the T-bills. T-bills for years, people were telling me, Seb, you're crazy. T-bills are illiquid. And I was like, what do you mean, illiquid? The most liquid instrument in the world. But from a crypto perspective, it was like, no, I don't know where it lives. Is it even real? Is the US government real? Come on, it's a T-bill. It's safe. So that was now accepted. And now with the Fasanara and Midas, we are moving to try to improve a bit more on the private credit. And again, there are, I think, 5 people borrowing already from it. It's not a proof of concept. It's actual people using their own money for their own profit motive. For most of them, I assume it's profit they are looking for. And doing it to have a higher yield.
I may just add that the biggest problem we're ultimately solving for is this duration mismatch between DeFi and real world. That's effectively what it all comes down to. If we were to bring the traditional fund, which is just, as Sebastien said, a diversified source of yield. We have short duration private credit in there, but we do also have a digital asset sleeve. So it's built like an all-weather fund. But obviously, in terms of the actual fund, it works for traditional LPs, for insurance companies, for pension funds, to ensure that they get consistency of yield, which is great. But if you're lend looping, obviously it's very different dynamics. So I've been extremely fortunate to work with the Midas team and with Steakhouse to come up with this token construct that allows you to have atomic liquidity as well as liquidity, which is more normal with the fund. So really investors, and again, having someone like Julien from Stake now being one of the first in that is a really great sign of the product because it's designed specifically for DeFi, and that's one of the unique parts of the offering.
Yeah, if I can add on top of this alpha, well, at Stake Capital, we've been looking at those type of products, structured product, exotic product, or how do you call it, whatever, for a very long time. And that's how we got involved back then in Centrifuge and many different real asset projects. And I think, yeah, as Denis mentioned, the depth of liquidity in traditional finance is by order of magnitude, maybe like 3-4 bigger than what you find in DeFi. So if you are able to type into this market, it's enormous. But it's extremely complex, and that's the reason it took like 3 months to build it correctly. Because you can actually build something very fast, but you are almost guaranteed to end up on Rec News. Doesn't say that we're not going to be ending up on Rec News, I hope not. But the point being, yeah, if you really do the things correctly, then you can really find massive opportunity in traditional finance that you can bring in DeFi and then serve DeFi. And now we're seeing across different lending market, more for Aave and etc., that you have now retail people using mobile phone in order to just borrow capital on top of their Bitcoin position, rather than selling them like 10 years ago, right? So this is a type of products and features that we bring into DeFi, thanks to the understanding of TradFi, and also with the experience of 10 years in the space. And that's what we are capable of doing.
So let's build on that. I'm curious to see what kind of, I think, risk considerations that you were looking at when you were considering, same as you, David, and when you're choosing this product, like what you went through and like, okay, this is a good product. And then for you on your side, Julien, from Steakhouse side, saying, okay, this is a good vault. We're comfortable with this.
Well, Steakhouse is there. Stake Capital. Yeah.
Sorry,
No,
my
it's
bad.
fine. It's fine. Well, you can ask them. We jumped multiple times in the phone call because I really wanted to understand the risk. And yeah, on my side, it's very different. I think I really want to understand each single point of failure, and also what's the. So you might understand the risk, but you also need to have exit strategy, or if something happens, do you have shutdown features? For example, the ability to only have the asset off-chain and then only the operation whatsoever on-chain, off and on-chain. Those different composability are very important because this is how you can actually isolate your risk. Building a product or structured product and saying there's no risk is impossible. And whatever you do in life, there's always risk. But what matters is like in security, you know, in like cybersecurity, you never say something is 100% secure. You always say it's secure because I understand the risk associated to that specific features. And then you take multiple different actions towards different scenarios. And this is what brings security to that feature. And it's the same in the product that we have built. And that's the reason why I'm joining. Of course, also, it's like when you invest in a product, you don't actually invest in the idea. People misconceptualize the concept of investing. You invest in people. And I think the reason is because people that have built this product are actually all experienced professional, like we've experienced before DeFi, believe me, but it exists. And strong experience in TradFi, so they understand the tools, they understand the product, they understand the risk, and they also have experience and strong experience of DeFi, multiple years of experience. This is extremely important on our side.
Yeah, I mean, from the underlying, it's actually very simple. What we wanted to ensure, and it's an interesting point that Sebastien made. So central banks have created this base rate and liquidity environment to favor yield as well as minimum volatility. Now, obviously, tokenized money market funds were a hot flavor of the month with rates being where they were. Now we're looking forward and we're saying, like, what will happen? Base rates go down, you know, the risk environment changes, but then what happens if we go into a crypto bull market? How does that compare? So what we really had to figure out is what underlying RWA will give you consistency of yield, but we'll do that whether you're in a bull or bear market. And how can we also pair that with short duration credit assets? And that's really what came down. But even then, still, that's not sufficient. And then that's where we had to work with Dennis and the Steakhouse team at the token level, and with Julien at this to make this. So maybe Dennis can comment a bit more on the actual token level, how we brought that to life.
Of course. First of all, thank you for everyone for the contribution on this. We can also discuss more in detail later because we don't want to completely segregate the talk. I'm very respectful of that, of course, as well. And also thank you for the Stable Summit in general. I think, Julien, you have done such a big thing moving the industry forward over the last years. When I went to the first Stable Summit in Paris, 3 years ago, the industry has changed so much. Tokenized T-bills were a novelty, and now they are commoditized, and we're getting to the space where the industry is actually becoming building real products. They're becoming very useful. So this is really a repo line on a private credit fund, on all weather private credit fund. With capital sourced from decentralized crypto markets. We can discuss the details there, but I think we've spent a lot of time. There's a report that Steakhouse has published on those things, and we can have a more balanced conversation in a panel too.
Yeah, so moving forward on that, do you think, and this might be for Martin because you're also one of the OGs bringing real-world assets on, have the technical challenges of bringing real-world assets on been solved? You know, is it now more so focused on financial, or maybe it's educational, user education? Where do you think the next pain point or issue is?
I think definitely the ecosystem is maturing. So more and more traditional finance knowledge is moving on-chain and building basically risk structures which are proven from traditional finance and just work better and faster on novel technology. And I think, you know, if it comes to utility, it's really what's leading edge right now is really being better on the distribution side. So be more efficient, how you have access to liquidity and manage liquidity. I think what you have built is a perfect example for that. Really make it more accessible and bring basically traditional finance assets closer to what we consider crypto assets from a utility perspective, if it comes to transferability, if it comes to liquidation, etc. And on the other hand, I think that is where it's most likely at the end, really, I think everyone in the market is really thrilled by that. But I think eventually what it needs is really also building structures which are order of magnitude more efficient if it comes to origination and asset management side, and that is also already starting. Where I really see actually that we have, you know, Block Tower Credit, can mention that as an example, an old partner of Centrifuge. They had built structures for managing basically credit right on chain. And I think that is what we're also seeing evolving, what we're also focusing on, and they most likely need to go in both directions. I think it's really rightfully focusing on distribution at the moment, but in parallel also actually managing origination and managing assets on chain is something which is evolving, which should happen in parallel, because that's where basically the efficiency is coming from. And combining both utilities, I think really what at the end will disrupt TradFi and then really bring us to where we really believe we see the trillions on chain, because it's not only faster, but it's also actually order of magnitude more efficient.
Do you feel that, this is a question for everybody, that banks creating their own private blockchain, like a private L2, is that something to be concerned about? Or is that something that's going to just, increase the entire like RWA market?
I think that's experiments, So, hey, no one is, I'm a little bit older than maybe the average. So there was one thing called an extranet. No one is using that anymore, a private internet. What the fuck, So, hey, and I think you will see later, do not discuss private blockchains or kind of permission blockchains in the future. It's more about, I think there's a multiverse of blockchains, still believe that, even if there will be blockchains which will provide the security to really store value and have value transfer in size. But for managing assets, for different trading use cases and so on, there will be most likely technical environments with a better utilities and maybe Ethereum, and that will happen, And then I really think totally okay if an asset is managed and originated on one blockchain and distributed on another and traded on a third. That is what I would most likely. It's already happening, I think, So, and it's also how we built the Centrifuge protocol, that you can basically independent manage assets from distributing them. Basically, do that on different chains.
Yeah, I think those big institutions are looking at the current market cap on like coin market cap, and they see like 200 billions, 100 billions, and they're like, what cannot be us, And I think it's extremely difficult for someone internal of big institutions or big bank to actually understand the big picture. So they're like, okay, maybe we should build a blockchain because we've been here for a long time. We have the capital, we have the resources, and we have some developers or AI developers whatsoever. And let's build a blockchain. But as correctly mentioned by Martin, they will soon realize that it's something extremely complex to maintain and also to actually have people using it, because you need developers, you need marketing, you need ecosystem, conference, you need to know what's happening. Like, for example, if Societe Generale or big banks, one of the largest banks in the world, has strong difficulties to just issue their own stablecoin across the market, not even building their own blockchain, it means a lot to the space. So then they will soon realize that it's barely impossible to build something that can compete with AWS because they want to be a cloud manager. What about using them? And that's a reality. It's too late for them. I'm quite surprised that they're still doing it, because it was like Goldman Sachs and it was like JP Morgan. They had tried in the past. There was like Hyper or something, not Hyperchain. But yeah, those will happen more and more, but it will be costly for them rather than joining like Ethereum ecosystem and then start building and issuing. They can even like maybe start or play with some L2, but this is what it's happening now. They spend time criticizing it, ignoring it, and now they have to adopt it, right?
It's a super hyperledger fabric, I think you're talking about.
Yeah, hyperledger.
Yeah, exactly. Back in the old days, exactly. And just
should have built Hyperliquid or Hyper. It works well.
Exactly. Yeah. And if you think about where it does have some use cases, is very much internal. Like Walmart, for example, used it as a tracking use case. But then just what we're talking about here in terms of fragmentation, almost by definition, liquidity is again fragmented. So.
And I think I don't hear anyone still wanting to do a private blockchain. I don't think there is Quantum Network. That's the only last one that is getting some traction. We don't know exactly how, because I never saw any block or any transaction. No one can see them if you're not part of the network, so it's difficult to know. But look, just recently, JP Morgan launched a tokenized bank deposit on Base. So that tells you everything. Deutsche Bank is trying to make a layer 2 on Ethereum. So they are on it for 6-8 months. I don't know where it is. Maybe it will succeed, maybe it will not. I think it was two parts. One, those big banks have a technical department that want to do technical stuff. So why not build a chain? And then they find out, wait a minute, if we build a chain, no one will come because we didn't have a use case, we didn't have a business. Then there is also the compliance team saying, well, we need our own blockchain so we can control everything, and so the compliance department is happy, because the compliance department wants to have everything permissioned, but you can already issue a token on a public blockchain, which could be a security token or whatnot, and it's permissioned, meaning you can only allow some people to use it. So you don't need to build a whole blockchain to achieve that. You can achieve that already on any layer one. So those are more the compliance issue. And then there is more, people are now thinking, well, what is the business case? Because actually, at the end of the day, all those are private companies or companies that need to have a profit at the end of the year. And then they will figure out, wait, how having our own blockchain, it will help us. Because what we want is, and a lot of asset managers, banks, everyone is going to blockchain to sell something to someone. So would you rather sell something on the blockchain you created that has no one, or go where everyone is? You can see all the whales that are on Ethereum or Solana or on Base. You see the activity, you see real usage. Why not selling to those people that are real people instead of selling to your own blockchain, which is completely a ghost town? So from a business perspective, for me, it's liquidity trumps everything. Everyone will go where liquidity is and activity is, because that's the most valuable set of any blockchain.
And that is only happening if it's public.
Yeah, exactly.
Absolutely, yeah. It's like the internet. The internet was successful because everyone basically could talk to everyone, and blockchain will only be successful when everyone can actually process data with everyone, completely trustless, independent from intermediaries, and that needs a public blockchain.
For me, there's only one answer. It's only a positive for the industry. Whether these private blockchains are successful is a completely different question. Now, you can ask the same question about utility, about the countless L2s, L3s, and L4s we see in the industry. They might be private by banks, they might be by some VC-backed startup. It's the same question that applies. But banks participating in the industry, it's only a net positive for the industry. Why? Because a blockchain is nothing else than a decentralized ledger. Where are ledgers used? Well, ledgers hold checks and balances, assets and liabilities, and banks happen to be the biggest users of ledgers. They might be on Excel, they might be in different forms, but store of value and accounting value is the ultimate use case of ledgers. Therefore, having those guys participate in decentralized ledgers is an essential thing. It's a really, really important thing. As Sebastien has highlighted, JP Morgan doing the tokenized deposits. It's the biggest news in the industry. It's huge. It's huge. It's massive. JP Morgan, Jamie Dimon 2 years ago, blockchain. I mean, remember his. It's huge. Bitcoin, 200K. Here we go. It's massive. It's very, very positive.
And if I just add another thing, all those institutions are saying where we are doing only permission stuff because we want KYC ML all the way down. If you look at BlackRock Beetle, the main users, I mean, there are 4 users of the institutional version, which is less costly, which is a COVID fund. 2 are Sky, I think, and 1 is Ethena. So 2 are decentralized stablecoin, which are completely permissioned on the back end. So BlackRock is not coming to create a product that is permissioned that no one will buy. What they want at the end of the day is increase asset under management. They are not here to make proof of concept or to make PR announcements. They want to increase asset under management, get fees, get richer, which is how it should work and how we will scale. And that's why liquidity trumps everything.
Very, very successful. Probably the most profitable money market launched ever. 50 bips fee for a 3-4 billion product in a couple of months. An incredible use case, a major positive for the industry. So very, very good. And BlackRock, not just that, they also did the ETFs with Bitcoin. It's a very simple product from their perspective. It's hugely profitable for them. And it's a positive for the industry. It's a very positive thing for the industry.
Yeah, and I would add to that, I slightly disagree with Dennis's point about the tokenization. So I think there is a use case there, which is accessibility, just to the point there, because they've opened up that money market fund to a whole new investor base and raised the AUM that they wouldn't be able to do that before. It's not, for example, liquidity, which is what many people think, but accessibility, I think, is a very good product market fit for tokenization.
And having direct access to the end customer, to the investor, which is novel for an asset manager like BlackRock.
All right, so we're out of time. I want to thank all the panelists, especially because I just threw out some random questions and we got some pretty key alpha. So thank you.